Howdy, Jacob here. Today we're looking at Acadia Healthcare company in the healthcare providers and services industry. 6.7 billion market cap on just under 8 billion enterprise value. Founded in Franklin, Tennessee. Founded in 2005. Growth has been pretty impressive, honestly. We're probably looking at low double-digit growth over the last 10 years per year annual. But return on invested capital very low, so it doesn't look like historically they've gotten a great return on the money invested back in the business. It looks like their use of cash has been paying down debt and previously paying a lot of acquisitions, but they actually sold off a little bit here. Balance sheet shows $100 million cash on hand with 1.3 billion long-term debt. I will say they've reduced it very heavily from 2017 to now. But this is what I say. I've been saying this for a while now. When you have long-term debt that comes due and you don't have the capability of paying for it with your cash from operations, you either have to refinance that debt or sell off some things. And it looks like they had a lot of debt coming due, and they had to do a devastation into a part of their business, sell off 1.3 billion, and use that to pay off their debt along with a little bit extra from their cash from operations. And so it's tough because that does hinder your ability to grow. And so you can leverage, but you don't want to leverage so much so that that's going to have to, that can be a possibility of occurring. You want to keep the business smooth. And this probably created a huge dip in their stock price and everything, whatever. And it is tough for the analyzer of the business too, because it changes some things. What was the thing that they sold off? Does it really affect their business? What are the ways in which it affects it? And it just makes it a little bit more tougher to where you might need a bigger margin of safety, maybe be more conservative with your assumptions. So those type of things can happen when you have a lot of debt. And we are seeing still a bit of debt because $1.3 billion is still pretty substantial with a 5-year average free cash flow of maybe 150 million. So we're looking at 9 times their 5-year average free cash flow still. So good amount of debt there. I will put that into my assumptions. So let's start making them. I think I'm going to put 17.5, saying that they might have to sell some things off, like they have previously, just to make that debt fine. Again, on a deeper dive, or if you just review this company in a little bit, you'll want to know when that debt's due. But for me, I'm just immediately taking conservatism because what I want is a company that's so obvious to buy that I need to do more research on. I don't want something that's, oh yeah, it's probably a decent buy, and then do more research on. That's a waste of my time. There's thousands of companies out there. I'd rather do a quick screen on all 1,000 companies, get maybe 10 or so that are obvious to me, and then do some deeper dives on them, which is why it takes a little bit for companies to really sprout out as deals for me. But, I do think that's the most appropriate way to approach these things, unless, you dwindle down companies to your small circle of competence. I think it's then easier to do deeper dives. But if your extensive knowledge is in mathematics and risk management, assumption setting, and everything, I do think this is the most appropriate way. So on the revenue side, I'll say maybe it dampens a little bit, but it's still pretty impressive. Maybe let's go 7%, probably in line with market average P, price to free cash flow. Let's do a little bit of a range, 4 and 5. Looks like from stock-based compensation, about 32 million, 30 million. Yeah, so it's not going to affect their share change too much. Yeah, it just looks expensive for me here again. Yeah, I'm saying with my assumption it needs to fall 86%. Again, I don't even know if this is like the best business that I definitely need to own or anything. So I'd want to get it cheap. If you don't find a business that's just an absolutely amazing business, you're going to want to be conservative in your assumptions due to the fact that, it's not the most efficient business. It doesn't have a trademark to it. It's not a Coca-Cola, Costco that everybody knows. And so I think you want to get these companies cheap, and this price just doesn't scream cheap to me. But I do hope you enjoyed the video and have a great rest of your day. Thank you.